Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus podcast, and it's broker time. I love having brokers on the show because, guys, brokers, guess what? That's where these big commercial assets come from. You're not going to likely get direct to seller marketing to work for you with greater than, let's say, 60 or 80 units, because people that own assets of that size are smart enough and savvy enough to know that their value of their property is going to be maxed out by listing it and selling it through a broker. So, Greenlight Equity Group, we're all in on our broker relations game. We all of our eggs are in that basket as far as creating deal flow. And so to get to have a broker on the show and kind of give us his inside scoop into the industry and listening to his perspective on working with investors and working with operators like us is really, really valuable. So I hope you guys get a lot out of this. Welcoming today, Mr. Alex Olson. Alex is an established, as I mentioned, he's a commercial real estate agent or a broker who assists buyers in navigating multifamily properties in both Kansas and Missouri. And Alex has a breadth of knowledge in acquiring and managing commercial real estate as an investor himself. So with an extensive portfolio and over 15 years of experience, he's built a system to ensure buyers succeed. He has a system called the Buyer Representation Success System, BRSS, and he insightfully serves his clients by identifying opportunities and maximizing value in the disposition. In 2021 alone, Alex completed over 30 transactions in the multifamily and triple net space, resulting in over $40 million sold. That's outstanding. Good job, Alex.
Thank you.
And then Alex has a special expertise in the area of 1031 exchanges. He's been a highly sought after podcast guest. As a result, that's why we have him on here. And he's really good at explaining in-state and out-of-state, how in-state and out-of-state investors can maximize their 1031 exchange transactions and avoid capital gains taxes through identifying cash flowing deals, developing a trusted team, and ensuring that their 1031 exchange money is secure. Alex has built a solid reputation by going above and beyond for his clients, and he takes the time to understand their real estate goals and develop strategies for their greatest return. So, Alex, that's quite an intro, quite a bio, very impressive. And dude, I'm really excited to have you on the show. Welcome.
Thank you so much, man. This is fun. I love speaking with fellow investors. It's a great time.
Yeah, for sure. Cool. So let's start right there. So you are, in addition to being a broker and a 1031 expert, you are an investor yourself. You say you mentioned you have an extensive portfolio. What's your portfolio look like, and what kind of assets do you have in it?
Yeah, so I would say the extensive portfolio is really more focused on what locations that I'm investing in. Mm-hmm. So I've got units all around economic driving centers of the Kansas City metro. So I've got apartments around 39th and Main, which is, downtown right next to the streetcar extension, that is going live here in a couple of years. I have property that's right next to one of the two major universities, literally not a half block away from the university. I have another property that is very close to the University of Kansas Medical Center, which is 2 blocks away. And then I have other property out in the suburbs, which helps me diversify into other types of tenants. And then I'm also owner in actually the building I'm sitting in right now, which is my office, that has about 95% occupancy and also right along the streetcar extension line.
Nice.
So it's all my mindset from an investment standpoint, even with helping my investors as well as a client, is about economic drivers. And in fact, that's why I really kind of moved to Kansas City, was because I think I saw the economic drivers of the city being quite positive. And, even though I was in consumer finance 15 years, kind of prior to doing this stuff full time, I've always had my eyes and ears on the ground of investment and best practices and how to I call it how to not get rich quick, which, on the flip side really is how to build your wealth, right? I mean, so many people are after getting rich quick. And I think we all know that in the real estate game, you really don't, but you do build wealth faster than a lot of other asset classes.
Oh, that's so true. And I think it's like either 80 or 90% of millionaires and billionaires either built their wealth in real estate or hold their wealth in real estate, or a lot of their wealth in real estate. And when you look back over historical trends and the metrics of the multifamily asset in particular in real estate, what you see is a very steady growth pattern that is pretty much uninterrupted. Even in downturns, like what we had in 2008 and even in the 80s and before, multifamily does very, very well. It's very unvolatile. Is that the word? Unvolatile, something like that. And it's one of those two. It's a tremendous wealth builder. Obviously, I think everybody that's listening would agree, otherwise they wouldn't be here. So no big surprise there. But so are most of your buildings that you described, are they class A, class B? What does that look like?
Yeah, I think they would be described as class C plus, maybe.
Okay. Workforce level.
Yeah, exactly. So I don't really play in the class A game, and I'm definitely not in the class D game. I think the most, even through my experience as a real estate agent and real estate broker, is a lot of people tend to need the in-between, something that's nice and affordable, no slumlord type stuff. And, at the end of the day, I think that's also what there is the most of, right? I mean, there's mostly stuff that's older and in decent shape, but with opportunity. And that's what we focus on. Yeah.
Yeah. And like you said, there can be really great opportunity in those existing buildings that, maybe are 20 years old, 30 years old type products, in that, you can often buy those products for less than replacement cost, and even after you do a nice renovation and a update on the units and maybe the exterior and do some CapEx around the complex, you're still getting a tremendous value in that you're getting it less than what you could build it for. So that's really cool. Let's talk about Kansas City for just a minute. I've always been under the impression that Kansas City is more of a cash flow market where you can buy properties that cash flow really nicely and are going to pay your debt service, going to pay your expenses, going to pay even a preferred return to your investors, and maybe even some cash flow to you. That's what we look for in properties. Like our investors expect that, and that's what we go after. what's the growth like in Kansas City? Because my impression has been, you know, in very general terms, you can talk about how markets are either going to be cash flow markets or growth markets, and sometimes you've got a mixture of the two. Is Kansas City an example of a market that's growing in addition to cash flowing?
Yeah, I totally would agree with that last statement. It is a cash flow market for sure. And on some levels, it's kind of boring, meaning, hey, look, it just kind of keeps going up slowly compared to obviously like LA or Las Vegas or Austin or something like that. However, there is a lot of certain pockets, and there's a lot of pockets, to be frank, because Kansas City is a growing population. It's got 2 different states involved. Mm-hmm. It's got multiple municipalities that are of size. Yeah. And with that, everybody gets aggressive around, economic drivers, and they want to attract more people to those centers, right? And so Kansas City spread out. And within that, there are multiple pockets of, hey, let's buy in. And it's what you'd expect, right? If you bought in, let's say, Overland Park, Kansas, which is a large suburb in Kansas City with amazing schools, very high income, that's going to appreciate faster than something, say, in a town called Independence, which also has 100,000 people, but it's had 100,000 people for about 50 years, meaning it hasn't grown or it hasn't shrunk. Yeah, that's a Class C market. Yeah. So I mean, it's definitely a cash flow market where you can leverage, until your heart's content. 75% leverage on out-of-state investors, and there's even a lot of local investors here that can do 80% leverage, even with today's rates and terms.
Is that just because the DSCR is so strong?
Yes, exactly.
Yeah, got it.
And that, of course, in the last couple months, really starting in May-ish, that kind of tweaked down to maybe even the local guys here at 75% LTV. And the out-of-state guys and gals were at, 70, 65%. But if you've got the right deals in place, and up until maybe last week, even rates were, in the 5.5 below 6% range with your local lenders here. So all those different factors, yes, it's a cash flow market. But we've seen some really good appreciation. My example is personal. I have that property here in Midtown, we call it, close to downtown. And that appreciated. I did a cash out refinance on that after about 3 years. And I got about 35% more on my money just by pulling the cash out. So, and I did some small things to upgrade it, but really just pushing rents and getting better tenants in there than what I paid for it. Mm-hmm. And showing the bank, hey, look, this is what this thing's worth now. And they said, yeah, no, it absolutely is. Here's an appraisal. And so you can get that in certain pockets. Streetcar extension is a big economic driver. Of course, all the employers, downtown economic drivers. And we're, like I said, we're kind of boring. We're not a master of anything, right? So we don't have this big hippie culture. We don't have this big tech culture or this big whatever culture. It's just we have a lot of the great aspects of economic drivers in the current market. And that a lot is around warehousing, distribution. We also have a new airport coming, which is not really, it's about passengers, taking people to and from different locations. But a lot of that engineering work that went into that is a lot about air tonnage, meaning how much is UPS delivering in and out of this town. We're in the middle of the country to get 3 hours to about anywhere, maximum 3 hours. Right. So that is a big impact, and all that stuff creates jobs. So blue collar jobs, which, oh, by the way, like the, B and C class apartment building. So it's, kind of boring, but at the same time, for me as a local guy, it's not.
Yeah. What are cap rates like for an asset or assets like what you own, a Class C plus sort of asset, workforce level?
Yeah. So I think right now you're probably looking at, if you're talking about what can I get this asset Class 2 within a reasonable time, meaning 12 months,
Yep.
you're probably looking at something that's maybe a 6.5%, hopefully a 7% cap rate if you put 10 grand a unit into it, to get your better countertops and better cabinets and paint colors.
Right.
That'll get you some of that. And you can push that up to a 7 cap if you've got all your ducks in a row. And that's really kind of what most people are looking at, taking maybe something that's a 4 cap and turn it into a 7 cap. And then you've got folks, of course, that are looking to take something that's a 6 cap that turns it into a 6.5 cap.
Right.
So a lot of different.
Do you really need to pay for like a 4 cap sometimes to get an asset?
Yeah, I mean, if you've got, I'll give you an example. Actually, this is, I don't want to say extreme example, but common. I've actually done that with an investor of mine that's a client where he's buying stuff that's a 2.5, 3 cap, but he can turn it into an 8 cap because he knows the area so well and has his systems in place.
Yeah.
So he's buying something for $7 million and going to put $2 million into it, and it'll be worth 12 in 24 months. That's a lot of work, and he's not getting any cash flow for the first 12 months. And so that's, and again, that's all with local lending, local banks. They are syndicating that deal. So it's harder for some of the syndicator, the people that are investing in that syndication to understand. But he's got a proven track record, so he's able to do that.
That's a massive rent bump that he's doing there, right? Like it sounds like he's basically doubling rents or so.
Yeah, I think they're sitting around $550 or something like that, and he can easily get $1,050 for them. So yeah, wow. I mean, you're right. It's almost doubling rents, and he's got to put, I think it's 15,000 per unit into it.
Yeah, wow.
That's 100 plus units. That's a lot of work, right?
Yeah.
But he sees the value of it, and he's done it in the past. Now you have other investors where, we've got something right now that is, it's 40 plus units on the smaller side, but 40 plus units. It's 100% occupied. It's right now operating at about a 6.25 cap rate, and based on the price they're wanting at it. And that'll sell, and somebody will come in there and bump rents $25-$50 as units turn, and it'll be a nice, decent cash flowing property for them. Now, as you and I both know, it's all about how you actually are managing the property is really what kind of determines the cap rate.
Absolutely. Yeah.
And that's the hardest part, right? Is figuring out what that real formula is in each individual market. And so it's a tough market, just like anywhere else in the US, probably, for buying real estate and hitting your amazing return metrics. But it's about peeling back the onion, finding the good deals, having confidence too, that, like we talked about at the beginning of this conversation, of appreciation and what's it really going to do in the next couple of years. You're buying it for cash flow, and that appreciation's kind of more of a bonus than something that's built into your pro forma.
Right. And that's the difference between a cash flow investor and an appreciation investor. Like, and we don't do deals in Salt Lake City where we're based, because the deals that you can do here are deals that you can buy for a 4 or maybe a 3.5 or something like that. And you can force appreciation through improvements and raising rents, and then sell it for a 3.5 or a 4. But you're never going to cash flow that property in the meantime. And so it's more of a speculation play, right? Like you're speculating that in 12 or 24 months, the market's still going to support a 3.5 or a 4 cap. And if it doesn't, you're in a tough spot, because you're going to end up not being able for that asset to support itself through its own cash flow. Maybe with your rent increases, you can. I mean, that's always a possibility. But if you're playing the speculation, forced appreciation, value add play, that's not your goal. You want to get in and get out. And so Fascinating. Well, I actually have a really good friend who got me started in real estate in like 2006. And he's still in the single family space, and he's coming on board with me as a coaching client. And which is there's some great, I don't know if you call it irony or synchronicity there, because he was essentially my coach when I got started.
That's
But
awesome.
yeah, it's pretty cool. He wants to get in the multifamily space, and guess where he's from? Kansas City.
See, I like it.
Yeah, his whole family's still there. He's a huge Chiefs fan. He's, the whole 9 yards. And we've already talked about that, about Kansas City being his target market because he's here in Utah as well. And that's for the reasons we just talked about. He's going to want to look out of state for a good growth market that has cash flow in it. And so
that's exactly right. You take a look at, okay, what's in my backyard? And if my backyard is, too expensive, okay, what's a place where I lived in? Okay, my lived in maybe might be too expensive, but what about my family? My family's from a place that is affordable, or still has ties there.
Yeah,
and that's going to give you your best chance for success in investing in real estate. I really like this guy. Sounds like a great guy.
I
like it.
He is a great guy. He's one of my favorite people, actually. Brad Lancaster. Shout out to Brad. He's been really important to me and in my path, and I hope that I can contribute as much to him as he has to me. But one of the things that I'm doing with coaching clients is I'm actually doing market visits with them. So there's a real good chance that Brad and I and his wife Tiffany will end up coming out and hanging out with you, Alex.
Yeah, I would love to, man. That would be a lot of fun. I would love to do that and show you some good and bad areas and great barbecue.
Yeah. I know the barbecue there is off the hook.
So
I haven't ever spent any time. I've driven through Kansas City a couple times, but I've never spent any time there. I'm original. And back to the market selection thing for a second. For us, we knew that we were going to be out of state from day one. And so we started looking at different markets that we didn't really know, like San Antonio was one of them, Albuquerque, New Mexico. Those are obviously relatively close to Salt Lake. And San Antonio is a great market. I wouldn't call Albuquerque a great market at this point, but what we found was that Columbus just kept popping up on our radar because of the, it's got a lot of similar qualities to Kansas City with probably a little more pop, like with the university there, the Ohio State and the state capital. And now it's becoming a major tech center with Intel building their plant there. But for us, it was a natural place for us to go and start working in, because I'm from Cincinnati. I'm from an hour and a half, 2 hours down the road. And I went to college in Ohio. I've got my Ohio Bobcat, Ohio University Bobcats. I've got my shirt on today. And so, and that's only an hour and a half from Athens, where Ohio University is only about an hour and a half from Columbus. So I used to road trip up there a lot and know the area. I have lots of friends there, lots of ties there, and my family's just an hour and a half down the road. So it's made all kinds of sense for us to invest there. And like you said, it's not, obviously, if you're in a great market and you are, and it meets all of your metrics and all of your buying criteria, by all means invest there, because you've got a competitive home field advantage that out-of-state investors don't have. And that gives you a lot of ground. Like, it gives you a lot of, forward momentum right out of the gate. But to your point, Alex, like, if you're not going to invest in your backyard, invest in your old backyard, or invest in your family's backyard, or invest in a backyard where you went to college, maybe. Like, those are ways, once again, of getting some competitive advantage and and some market knowledge. And then, if none of that is applicable to you, like we started in Oklahoma City with no ties, none of this stuff that we're talking about. I had never been there before. Like my partner, Chelsea Garber, had spent a lot of time there, and but just for the purpose of this, like she didn't go to school there. She didn't travel there for any reason other than to start this venture up. So it's very possible to start in a market cold and be successful. There's nothing wrong with that model either. Well, good stuff. Let's switch gears. I'd be remiss to not have you talk a little bit about, I've got two kind of things I want to talk to you about, but the first one, let's talk about 1031 exchanges for a few minutes. Listeners, you probably know what a 1031 exchange is, but basically it's when you sell a piece of real estate, you're going to get charged capital gains taxes on the difference between your cost basis and your sales price, so your profit. And one way to avoid paying capital gains on that profit is to roll the profit into a new property, and what they call a new like property. And that's going to basically create an exchange that the IRS recognizes as a tax-free. Would you call it a tax-free exchange? Is that
tax-deferred?
Tax-deferred. Thank you. Yes.
Mm-hmm.
Very important distinction there.
Yeah.
But yeah, so you're deferring paying taxes on that profit because you've just put that profit into a new piece of real estate. It's one way the IRS incentivizes us to invest in real estate. So, Alex, talk a little bit about this niche for you, and what gives you a competitive advantage in this niche. Like, how have you kind of specialized in it?
Yeah. So the 1031 exchange, the one reason why I really love the 1031 exchange is because it is a true tax deferred wealth building tool. And the best example, and I've got clients that do this all the time, even people in syndications or in large funds or whatever, but they've got a duplex or a house or something or a fourplex that's left over, or, they got land in California or wherever. And they're like, well, shoot, I don't want to sell this and pay the capital gains on it. I said, well, you don't need to. Let's sell this and defer all those gains into a cash flowing market. And so that's what obviously Kansas City is. We talked about that at the beginning. And our niche is actually helping people that are considering that or are in the middle of it. So with the 1031 exchange, you only have 45 days to identify up to 3 properties.
It's so fast. Yeah.
Yeah. And that goes by really quick.
Yeah.
And at the beginning of that, you also only have 6 months to close out at least one of those 3 properties. Otherwise, you're going to be paying your capital gains tax on that. And by the way, the government doesn't care if your mom's sick, you're sick, you get in a car accident or whatever. So those dates are hard and fast. If it falls on Christmas Day, well, that's too bad. So you really need to be on the ball with all those different things. And there are so many people from California. Actually, I have several clients from the Salt Lake City area, Denver, Dallas, East Coast, where they sell these houses, duplexes, or even a lot of Kansas City folks, right, where they want to upgrade their property. So they sell a duplex. I've got a client right now selling a duplex in Oakland, and she's going to have a couple $1,000,000 to put into Kansas City, or thinking about it, right? And so how do we help them? We actually help them identify those 3 properties. We're a real estate transaction company. We're a real estate brokerage firm. We help them with their property manager, their attorneys, their insurance, their title company, of course, everything you can think of. The most important piece, of course, is identifying and finding properties. So we do a lot of off-market calling. So we're calling sellers all over the Kansas City market, asking them, hey, look, I've got a willing and able buyer right here wanting to buy and are willing to pay a decent price for it. So that's really our niche market, is helping people in that 1031 crunch get into a replacement property that's going to cash flow a lot better. That example I talk to you about, and I post about this on LinkedIn all the time. An older example, but another California investor, of course, is they sold their house for $1 million. They took that $1 million because they had no debt on it. They paid it off. They took that $1 million and bought 32 units here in Kansas City. And they were cash flowing maybe $24,000 a year off that house in Oakland with no debt.
Mm-hmm.
Well, then they're fully leveraged here, 75% LTV, and they're getting $72,000 a year.
Nice.
Doing nothing. They don't have to drive by the property. I don't even think they've ever been to the city. I mean, sure, they have property they gotta manage.
Right.
But and they did that with no, they didn't inject any more capital in what they already had in their property. They didn't, pay any taxes on that at this point yet, right? They deferred them.
Yeah.
And now they're asking me, okay, how can we get some more of these units? So that's the power of the 1031 exchange. If you have something that is maybe depreciated out, or you have no debt left on it, or you're tired of it, or you inherited it, or whatever the case may be, the 1031 allows you to accelerate building your wealth. And that's what we love doing, is helping people do that.
Yeah. Yeah. It's a great vehicle. And you see it all the time in real estate. My understanding of 1031s in relation to syndications is that it's pretty tough to pull off. You gotta set the syndication up as a tenant in common, which involves some really complex, in-depth legal work that is very expensive. We've looked into it because we've had 1031 investors that have wanted to get into our projects, and it just seemed prohibitive for us. Is that the case, or are there any magic bullets for that to solve that?
Yeah, it is. It's a lot about timing on syndication side, right? Is setting up and having you're taking a risk as a syndicator to set up that tenancy in common for specific deals. And I've got firms and clients and contacts here in KC that have those types of deals available from time to time. So that way people can be passive investors into a large deal.
Yeah.
But they are intensive, and they, usually you want to have a lot more money than just 50,000, 100,000 going into it. Cause you probably, as a syndicator, only want, 4 or 5 owners in that thing.
Yeah.
I think that there is even a niche that could be built around something like that.
Sure.
But, your returns are a lot different. It's harder for people to wrap their mind around it. But there's also other opportunities that syndicators, I think, could do, which is produce more of an asset managed type of situation where they're buying the property, but you're managing the asset. So you're still able to get a lot more of your asset management fees, all your other kind of fees you're getting, but it's not a syndication or a TIC. But that's just, more my thoughts and experience than, real knowledge.
Well, yeah. And, you have the experience and the knowledge base to kind of get creative with this, it sounds like.
Yeah.
So what if, let's say, for instance, obviously you're Kansas City and Missouri based, but have you ever had a situation where somebody buys something, say anywhere, let's say either in Kansas City or somewhere else, sets it up as a tenant in common specifically to accept 1031 exchange money, and then you kind of needing a place to put a client's money? Have you ever run into that sort of scenario?
Yeah. There's a firm here, like I was referencing, that's what they would do. They set up deals in advance.
Okay.
That are going to be available for someone that is doing a tenancy in common, that needs to for 1031.
Yeah.
Right. And that may come on because the investors that they have as, investors in their syndication are going, hey, look, I'm selling some stuff. I've got some 1031 money. Maybe there's 3 or 4 or 5 of those that want to do that. And also on my side, we have, there's a lot of investors I call, a lot of property owners I call. I say, hey, look, I got a 1031 investor that wants to buy your property. They say, well, cool. I would be in the same boat as they are, right?
Yeah, right.
And so we've developed a transformational exit strategy, and that's not to get out of real estate. That exit strategy is to get out of that property.
Yeah.
And one of the options for them, of course, is to invest in a TIC. And so, I'm sure I'm scrambling to try and find deals for these people that are, completely passive into a TIC investment. They're in high demand, and it's hard to find them. And, we try to lay out, okay, look, here's 4 or 5 different options for them. All of these could be gone, by the way, by the time you sell your property, because take 50, 90 days, plus these are under contract, that kind of thing. So, but having good relationships with syndicators and investors that have those often enough has at least allowed us to, for those people, even to segment and create a niche for themselves as well.
All right. So you got my wheels turning a little bit here, Alex. We're talking. So if I hear you right, it might very well behoove us as syndicators and operators at Greenlight to consider going ahead and setting up one of our deals as a TIC, and with the express purpose of bringing in 1031 exchange money, and you just mentioned they're in high demand, right? Like those projects are. So does that seem like a reasonable strategy option to you?
Yeah, I think that would be a great idea. I've been to several different conferences that are all exchange focused. And even those guys and gals there, they're looking for, how can I invest, TIC into this? I've got a 1031 money. How can I be passive? And everybody knows that, yeah, it's expensive, and yeah, it takes more time, and yeah, there's a lot more risk, because, if the deal falls through, then that person's 1031 money is gone, and now they're paying taxes, and you've, kind of pissed them off. But, that I think there is high demand for that type of property to be able to invest in with decent returns. I don't even think they got to be home run returns. It's like, how can I be passive? I don't want a DST. How can I be passive other than a DST? Well, here's an option: this tenancy in common deal.
Well, I really like that a lot. I mean, that's a huge takeaway for me. As managing partner at Greenlight and deal structure and all that stuff. That sounds fascinating. And one last question on that, and then we'll move on. But is it relatively easy to source 1031 folks that need to place in a TIC? Is that something that's relatively easy to find?
I think it is. Of course, that's the world I live in, right? It's 1031 exchanges. So
Sure.
And I don't know how large your investor base is that are investing into Greenlight properties.
Right.
But if it's pretty dang, large, I would assume if you've got an email blast that says, this is an opportunity for those under 1031 exchange deadline, soon to be, or blah, 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 whatever, you would get some good responses from people that, like I talked about before, they have a duplex, a house, or whatever.
Yeah.
And, their relatives and friends and family and everybody else probably has some too. And you could probably do some, teasers around that, right, to gauge interest before you actually go ahead and set that up. Yeah. And I don't know if you guys are buy and hold long-term, like we never sell kind of thing, but think about it from yourself. If you've got properties that you're selling, you need to 1031 exchange.
Yeah.
And so you might as well set up a opportunity for yourself to invest in, and of course, invite other investors into that as well.
That's a great point. Great point. I love it. Good stuff there, Alex. So, all right. So we're kind of starting to run up against time, but I want to just ask you a couple questions along the lines of how to be a good operator, like from in your eyes, and how to be. My friend Bo Beery, he's a broker in Florida.
Yeah.
You smiled. It looks like
yeah.
He wrote a really great book. I think it's a fantastic book. Shout out to him on becoming what he calls an elite investor. And an elite investor is somebody that a broker like you, Alex, would, take, let's say, an off-market deal, off-market opportunity to, or maybe an opportunity that you want 3 or 4 or 5 buyers to look at, but you don't want to expose to the entire market. That's like the position you want to be in if you're in my shoes or in a lot of our listeners' shoes who are trying to get deals done. Just to put it simply, like, we want in with you guys, right? Like we want we want to be top of mind with you, and we want to have the reputation with you that we transact, that we close, that we're good people to work with, that we're easy to work with. In your eyes, what are the kind of the magic ingredients of somebody that, I mean, I'm sure you can think of a number of examples in your world of people that are kind of go-to investors for you. What are the common characteristics of people like that?
Yeah, I love this question because, you probably know any broker, right, in any town probably gets calls, emails from syndicators from all over the place saying
every day, right?
What do you got off market? What do you, this and that, these things. Dude, I don't trust. I mean, I want to build a relationship with you, but I don't trust you yet, right? So why would I send this to you versus somebody else? So I think there are some very good keys to that. And I know as a syndicator, you got to look at the returns that you're giving to your investors. And I'm never would say, hey, look, you got to lower your return requirements. But I will say, look at it from a little bit different angle. If you know that this property is going to be bought by somebody and it fits most of your boxes, how can you make it fit all your boxes? Because you know that the broker you're working with is a top broker, right? Like, for example, you mentioned Bo Beery. What if he's got the best properties available all the time? Well, if you want to get started with somebody like him, maybe you got to overpay for that first one. I don't want to overpay, but maybe you got to jump the line. How do you jump the line? Well, you got to overpay, or you definitely can't or shouldn't go in there and retrade the crap out of it because it's got an old roof. Well, you could have seen the roof is old from a drone video, right? It doesn't take rocket science for some of those things. So I think, getting in there, being aggressive on your offer price and continuing to be aggressive on your offer price. Maybe you don't get the first 3 or 5 or 10. I've got a guy right now who he never won. I say won, but he never purchased anything until now. He's bought 2 from me. So the first 5 or 6 he offered on, he was pretty close, but he wasn't the best. And now he's bought 2 more because, I don't know why it's fitting him now more than it was before, but he's now a great buyer. So that's it. And then also, the retrades and the closings and extending closings and all those kind of things are something that becomes very dangerous, especially for like in how my business is, which I don't do a lot of listings. Most everything's off market, and I'm either a transaction broker or I represent the buyer. So it's risky for off market guys to go, okay, let's put this under contract, and then it falls through, and then the seller is like, F you, Mr. Broker, you did a horrible job in bringing me a terrible buyer. So just think about all of those things and really what's important in closing out a transaction. It's always okay to ask, but to go into it, you say, hey, look, I've got to have these things in order to get done. And then you say, well, I also need these 3 other things. Sticking to your word is huge with broker, at least with my kind of broker people, is, this is what I need. This is what I want. Let's go get it done. And don't stray from that. And I think, you'll be on top of a lot of brokers' boards.
Yeah, that's all great stuff. Listeners, rewind that 3 or 4 minutes and listen to it again. That's good. Really, really good, powerful stuff. And, you talked about the guy that put in 5, 6 offers, didn't get them. And then now he has 2 with you. Those 5, 6 offers that he wrote were not wasted efforts, because you got a chance to build a relationship with him through all of that interaction and all of that, the offer writing and the responses and counter offers and all that stuff. So you got a chance to really get a feel for who he was. And it sounds like, in essence, he kind of earned your trust to a certain degree by just being persistent and professional. And now he's got what he was going after, which was some deal flow from you. So,
Exactly.
yeah. So, a lot of times in this business, guys, for listeners, think about this as the long game, right? Like, this is very, very, very much the long game. It's much more important for you to build a relationship with Alex Olson in Kansas City and know his birthday and know about his hobbies and what he does for fun and all that stuff than it is to get a deal from him, right? And that's a key thing to realize, because in the single family space, it's all about just getting the deal. Get the deal done, transactional relationship. You probably only deal with that person once. Boom, you're on to the next one. These relationships that you're building in the commercial space are ideally long-term, even lifelong relationships where hopefully you genuinely enjoy each other and genuinely enjoy working together and are very, highly pro and highly effective at what you're doing. So, listeners that are starting out in broker relations and, my coaching clients, like, this is the stuff that it takes to break in, and it's always going to be we say it all the time. That first deal is always the toughest, because you don't have things like a relationship in place with an Alex Olson that's going to trust you and have you do an off-market opportunity yet. But the key is getting there, right? And there's ways of getting there that are very effective. They're not necessarily overnight, but they're very effective. So that's all awesome. Really, really high value truth nuggets and wisdom bombs, as my friend Sterling White would say. Yep. So okay, great. Well, we're getting pretty close here to needing to wrap it up, but I guess just not to be repetitive on the last question, but the listeners here are eager to move to the next level, right? They're either cracking the code into their first deal, or they've done a deal or two or three and they're looking to scale up. You've been in the business, about 15 years, and you've done a ton of transactions. You continue to do high volume and do great stuff. What would you say to that investor that's, trying to break in and trying to like level up into being that kind of a lead investor status? What's an important thing for them to like keep in mind in their mindset?
I think it's all about when you're looking at deals, you have to look at what are your return metrics. And if you pay, I say this, I'm not asking people to pay a little bit more, but what I'm saying is, if you can pay a little bit more, your returns are going to be less, but you're going to get your first deal done.
Right.
So the value of getting that first deal done, it's not that I'm going to become a millionaire or going to become rich, or I'm going to make, $2,000 a month in cash flow or $50,000 a month in cash flow. That first deal, at least a good chunk of that's got to be, what am I going to learn from it? That's what I did too when I was buying my first deal. Is, well, shoot, maybe I'm overpaying for this thing, but at the end of the day, I don't care, because I'm knocking out how to do a commercial loan. I'm knocking out how to do a commercial appraisal. I'm knocking out all these different things that I can learn from that really doesn't have a great value number attached to it. But and the other thing too, you got to understand, when you're buying real estate, people, I think, make a lot of mistakes on the house flipping, which is not an investment, by the way. That's just a way to make money.
That's true. Yeah, it's a paycheck. Yep, totally. Paycheck
flipping houses. But when they're in the real estate investing world, you can sell that property, a year later and defer all your gains on it if you have any, or if you lose some money on it, you can sell it right away. If you were desperate, you hated the idea of it, made a mistake, and get out of it and buy something else.
Right.
So, and I know it's hard. I know it's hard to see past that, but all those things are possible. So real estate investment is not, something that you're signing your life away to it's something that you're doing, you're learning. It's okay to maybe overpay a little bit on that first one, and tighten down the screws on the next one.
Yeah, I like that philosophy a lot. That first deal doesn't have to check all the boxes of like a home run deal for you. Ideally, it checks a few, but look, I mean, the way you score runs in baseball is you get them up, get them over, get them on, get them over, get them in, right? Like you need to get on base before you're going to score runs, and in multiple quantities. So, getting on the mat, I think of it as like putting yourself on the map, getting that first deal done. Like you said, you're knocking out the loan, you're knocking out third parties, you're knocking out raising capital. You're putting an OM together for the first time. Like all those, you're underwriting for kind of maybe the first time or something like that. So yeah, I mean, those are all super key things to master. And you also just want to be on the board. Like you're a player at that point when you get that first deal done. Like people start calling you, brokers start calling you. Hey, I saw that you just bought this property and we've got some other opportunities coming up. What are you looking for? Like that happens. That's real. That happens a lot. So, this is for listeners, this is a multi-pronged attack that you're doing, right? Whether you're doing your first deal or your fifth deal or your 10th deal, there's still a lot of balls that you have to keep it up in the air. And that's just the reality of this business. It's an entrepreneurial venture for a reason. And not everybody's wired to do it, but chances are if you've listened to this episode and you've listened to the whole thing here to the end, like you're probably wired to do it. Like it's kind of natural selection here. So, so Alex, awesome stuff. If listeners want to reach you and learn more about the 1031 stuff that you do, or the Kansas City market, or becoming a buyer there, what's the best way for them to reach you?
Yeah, a couple ways. One, XchangeCRE.com. That's with an X, kind of like you can see behind me here, kind of.
Yep.
XchangeCRE.com is my website. Got my contact info there. I love communicating and hanging out on LinkedIn. So I'm all over that, posting nuggets that we find either about Kansas City or, examples of 1031 stuff, or, people that have done well. So those two favorite places. Of course, you'll email me, alex@XchangeCRE.com, and love to start a conversation.
I love it. So for listeners, it's XchangeCRE.com with no E at the end. So it's XChangeCRE.com. So seek out Alex. Like he's a great resource. We all should know about these 1031 tools at the very least. And if you're in market analysis mode, like Kansas City has Tate seal approval. I'll hold my right hand up and say, based on Alex's expertise and what he had to share, that's a great market to be in, because it is a very high cash flow market. And that cures so many ills when you've got great cash flow coming in. So Alex, thanks a ton, man. This was a fantastic hour or so. I really appreciate all the wisdom that you brought and the value that you added.
Well, thanks for having me on, man. I love talking about this stuff.
Yeah, I can tell you're definitely passionate, and I can tell you enjoy it. And that makes all the difference with when you're working with people that love what they do and are lit up by it. It makes such a big difference. So great stuff, Alex. Well, listeners, thank you. We love you guys. We're so grateful for you listening, and hopefully you're getting great stuff out of the podcast in general. We're doing 2 episodes a week now. And so we're, every few days you get to check in with a new guru. Today's guru was Alex Olson of Xchange CRE. And thanks again, Alex. And thank you, listeners. We will see you on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, Go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.